OPEC has consistently advocated a balanced approach where nothing and no one should be dismissed. We need to embrace all energies.
And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. You got to bring it down.
OPEC's recent decision to cut oil production has sent shockwaves across the global energy market, leading many wondering if this could be the beginning of the end for U.S. dominance in the oil industry. The move, which comes amidst a backdrop of rising electric vehicle sales, renewable energy growth, and climate policy pressures, has thrown America's energy strategy off balance. In March 2025, OPEC Plus agreed to increase daily oil production by a modest 138,000 barrels in April, marking the first production increase since 2022. However, this follows a period of significant production cuts led by major players like Saudi Arabia, who argue that reduced output is necessary to keep prices high and protect their income. Meanwhile, the U.S. has been pushing to maximize its own production through shale oil, with December 2024 seeing a record high of 13.49 million barrels per day. But is this enough to counter OPEC's strategy? Some experts believe that the successive production cuts announced by OPEC Plus members have put U.S. oil producers in a precarious position. While high prices may initially seem to benefit U.S. shale oil, market volatility and geopolitical tensions could lead major buyers to seek alternative supplies. U.S. oil refineries are running at record capacity, but questions remain about what will happen if demand falls or international trade channels narrow. The rise of electric vehicles adds another layer of complexity to the situation. Global EV sales are expected to surge by 18% to over 20 million units by 2025, potentially putting a significant dent in oil demand. Major automakers are rapidly shifting their focus to electric, with many countries setting ambitious targets to phase out gasoline-powered cars entirely. As the world watches this high-stakes chess match unfold, it's clear that the oil industry is facing unprecedented challenges on multiple fronts. Will OPEC's gambit pay off, cementing their control over global oil prices? Or will the U.S. find a way to adapt and maintain its position as an energy superpower? The answers to these questions could have far-reaching implications not just for the energy sector, but for the global economy as a whole. As the oil market drama unfolds, geopolitical tensions are adding fuel to the fire. The once strong relationship between the United States and Saudi Arabia has grown increasingly frosty in recent years, with Crown Prince Mohammed bin Salman asserting that the kingdom will prioritize its own interests over bowing to U.S. pressure. Russia, already at odds with the West over the ongoing conflict in Ukraine, is also a key player in the OPEC Plus alliance. Some analysts see the production cuts as a deliberate move by Moscow and Riyadh to undermine the U.S. economy and weaken Washington's global influence. The logic is simple. Higher oil prices lead to higher inflation, which in turn increases the risk of a recession in the U.S. A faltering U.S. economy would be a blow to American prestige and could force Washington to scale back its international commitments. However, this strategy is not without risks for OPEC. If prices rise too high, it could trigger a global economic downturn that would ultimately hurt demand for oil and lead to lower revenues for producers. The cartel must walk a fine line, balancing their desire for short-term gains with the need to avoid killing the goose that lays the golden eggs. For the U.S., the situation is a stark reminder of the limitations of energy independence in an interconnected world. Even with booming shale production, the U.S. cannot fully insulate itself from the machinations of foreign oil producers. Despite the current turmoil, it's premature to write the obituary for the oil industry just yet. While the long-term outlook for fossil fuels is certainly cloudy, the transition to a post-oil world will likely be a gradual process rather than an abrupt collapse. Oil still plays a critical role in the global economy, from transportation and manufacturing to petrochemicals and plastics. Even with the rapid growth of electric vehicles, it will take years, if not decades, for EVs to fully displace internal combustion engines. And as developing countries continue to industrialize and expand their middle classes, demand for oil is likely to remain robust in the near to medium term. That said, the oil industry is undoubtedly facing headwinds. In addition to the immediate challenges posed by OPEC's production cuts and the U.S. shale boom, oil companies are coming under increasing pressure from investors and the public to address climate change and reduce their carbon footprints. This has led to a growing focus on renewable energy and clean technologies, even among traditional oil majors. Companies like BP, Shell, and Total are investing billions in solar, wind, and hydrogen projects, aiming to diversify their portfolios and position themselves for a low-carbon future. In the U.S., the Biden administration has made climate action a top priority, pledging to decarbonize the power sector by 2035 and achieve net zero emissions economy-wide by 2050. While these goals face political and practical hurdles, they send a clear signal that the days of unfettered fossil fuel use are numbered. Ultimately, the future of oil will depend on a complex interplay of market forces, technological innovation, and policy choices. OPEC's actions may provide a short-term boost to prices, but they cannot hold back the tide of change indefinitely. The industry that fueled the 20th century must now reinvent itself for the 21st or risk being left behind. For U.S. policymakers, the OPEC production cuts are a stark reminder of the challenges in navigating the energy transition. On one hand, Washington wants to support domestic oil and gas producers to ensure stable supplies and protect American jobs. On the other, there's growing pressure to take bold action on climate change and accelerate the shift away from fossil fuels. In the short term, the Biden administration has few good options to counter OPEC's move. Releasing oil from the Strategic Petroleum Reserve can provide some temporary relief, but it's not a long-term solution. And while boosting U.S. shale production could help offset the impact of OPEC's cuts, it risks undermining the administration's climate agenda. Longer term, the U.S. will need to double down on efforts to speed the deployment of clean energy technologies and reduce dependence on oil across the economy. This could include everything from expanding electric vehicle incentives and tightening fuel efficiency standards to investing in research and development for advanced batteries and hydrogen fuel cells. At the same time, policymakers must grapple with the social and economic implications of the energy transition. Millions of Americans still depend on the oil and gas industry for their livelihoods, and many communities have been built around fossil fuel extraction and processing. Finding ways to support these workers and diversify local economies will be critical to ensuring a just and equitable transition. Globally, the U.S. must also navigate shifting alliances and power dynamics as the world moves toward a lower carbon future. While tensions with Saudi Arabia and Russia may dominate headlines today, the real competition in the decades ahead is likely to center on clean energy technologies and supply chains. Securing access to critical minerals, scaling up renewable manufacturing, and forging new partnerships with key players like the European Union and China could all be key to maintaining American competitiveness in a post-oil world. Above all, the current crisis underscores the urgency of action on climate change. Every year that passes without meaningful progress to reduce emissions makes the ultimate transition more difficult and disruptive. By seizing the opportunity to accelerate the shift to clean energy, the U.S. can not only reduce its vulnerability to the whims of foreign oil producers, but also position itself as a leader in the industries of the future. As we've seen, OPEC's production cuts have sent ripples through the global oil market and raised questions about the future of U.S. energy dominance. While some see this as a potential tipping point for the industry, the reality is likely to be more nuanced. In the near term, high prices could indeed pose challenges for the U.S. economy and create headaches for policymakers in Washington. But over the longer term, the fundamentals of supply and demand will continue to drive the market. As long as there is a need for oil, producers will find a way to meet that demand, whether it's through shale, deepwater drilling, or other unconventional sources. At the same time, the imperative of climate action is only growing stronger. With mounting public pressure and increasingly ambitious policy goals, the oil industry faces an existential challenge to adapt and evolve. Companies that fail to embrace the energy transition risk being left behind, while those that innovate and diversify could emerge as leaders in a low-carbon world. For the U.S., the path forward will require a delicate balancing act between energy security, economic competitiveness, and environmental sustainability. By investing in clean technologies, supporting workers and communities affected by the transition, and engaging constructively with allies and partners around the world, America can chart a course toward a more resilient and prosperous future. Ultimately, the story of oil is far from over. But as the world grapples with the urgent need to address climate change, it's clear that the industry is entering a new chapter. How this story ends will depend on the choices we make today, as individuals, as companies, and as nations. By working together to navigate the challenges and opportunities ahead, we can build a brighter, cleaner, and more equitable energy future for all.